Okay, let me tell you about a short squeeze that failed spectacularly. It was January 2021. An army of Reddit traders, fresh off the GameStop victory, turned their attention to silver. Hashtags like #silversqueeze were trending. The price jumped 8% in a single day to about $29. It felt like a revolution. But within 2 weeks, the whole movement fizzled out. Why? Because trying to squeeze the silver market with social media hype is like trying to drain the ocean with a bucket. The silver market trades about $1.5 trillion annually. It's simply too big, too liquid, and at that time, there was no actual physical shortage. It was all paper, promises, and hope. So, here we are, December 2025, and silver just did something that should make every skeptic sit up, $64.245 per ounce. Not just a new high, but a level that blows past every historical comparison. And this time, the story isn't trending on Reddit. It's happening in the silent, vaulted corridors of London and New York. This isn't a speculative frenzy. This is a physical market panic. And it's exposing a crack in the financial system that could have profound implications. The question everyone is asking, is this the real short squeeze or just another fake out? To understand that, you need to see what happened in October 2025. That's when the fiction of a deep, liquid silver market collided with the reality of empty vaults. On the 8th of October 2025, a single order for 1,000 tons of silver hit the London market. To put that in perspective, that's over 32 million ounces. The market froze instantly. The cost to borrow physical silver, known as the lease rate, didn't just tick up. It skyrocketed from a normal 0.25% to an incomprehensible 200% annualized. Think about that for a second. Traders were willing to pay 200% interest just to get their hands on metal for a few days. That's not a market signal. That's a scream of panic. Traders withdrew. The major Swiss refiner METALOR announced it wouldn't return to the market until January 2026. The system had seized up. Why? Because the London Bullion Market Association, LBMA, could report holding 844 million ounces in its vaults, yet it couldn't deliver 1,000 tons, about 32 million ounces. How is that possible? The answer is the dirty secret of the silver market. Roughly 75–80% of that vaulted silver belongs to exchange-traded funds, ETFs. It's sitting in those vaults, but it's not for sale. It's allocated to back shares held by investors. The free float, the silver actually available to buy and sell, is terrifyingly thin. One analysis suggests the true liquid silver available in London may be measured in the tens of millions of ounces, not hundreds of millions. When India called for delivery, there was simply not enough metal in the right place at the right time. This is when the financial world started doing something it almost never does for silver. It started airlifting it, planes, not ships, because ships are too slow. The shortage was so acute that traders began physically flying bulky silver bars from New York to London to capture arbitrage profits and meet obligations. In October alone, nearly 54 million ounces flooded into London vaults, the largest single-month inflow in at least 9 years. That's metal that had to be ripped from other parts of the global system to plug a hole in London. Now, let's rewind and compare. The 2021 squeeze was a narrative. It was driven by sentiment, by tweets, by a collective dream of beating the banks. It failed because the fundamental ingredient, a genuine physical shortage, didn't exist. The 2025 squeeze is the opposite. It's a mathematical reality. It's driven by the 5th consecutive year of a structural supply deficit where industrial and investment demand simply outpaces what mines can produce. Projections for 2025 alone point to a shortfall of 150 million ounces or more. This deficit isn't speculative. It's being consumed. Solar panels, which now use about 20% of global silver supply, lock the metal away for 25 to 30 years. Electric vehicles use 2 to 3 times more silver than traditional cars. Every AI data center and 5G tower needs it. This is consumptive demand, not inventory hoarding. The metal leaves the market for good. So, is this the real short squeeze? The evidence screams yes. The 2021 event was a crowd trying to push a mountain. The 2025 event is the mountain itself crumbling, revealing there's less rock there than everyone thought. But, and this is a massive but, even a real short squeeze is fraught with peril. Let me break down the 3 ways this could still blow up in your face. First, regulatory intervention. We've seen this movie before. In 1980, the Hunt brothers were broken by rule changes. In 2011, exchanges hiked margin requirements, crushing the rally. If this liquidity crisis threatens major financial institutions, the regulators will step in. The COMEX, or LBMA, could change delivery rules, restrict new positions, or force liquidation to maintain orderly markets. They have the power, and they will use it. Second, demand destruction. Remember, over 60% of silver demand is now industrial. If the global economy tips into a meaningful recession, that demand craters. Solar projects get delayed. EV sales slump. Industrial users start destocking. In 2008, silver crashed over 50% from its high amid the financial crisis, even though the long-term bull story remained intact. A sharp economic slowdown could temporarily overwhelm the deficit story. Third, the psychology of profit. Silver is up roughly 100% in the past 12 months. That is an enormous, life-changing move for anyone who bought early. The temptation to take profits is overwhelming. If a wave of selling hits, it could trigger stop losses and create a self-reinforcing correction. A 15-20% pullback from here, back to the $50.52 range, would be brutal for anyone who bought at $64, even if the long-term thesis is correct. So, what should you watch? Here are the key indicators. 1. Silver lease rates. This is the canary in the coal mine. If they spike back toward 30%, 50%, or 200%, it means the physical market is again in panic mode. If they stay subdued, it suggests temporary relief. 2. LBMA vault flows. Watch the monthly data. The historic 5.4 million ounce inflow in October eased the crisis. If stocks start falling again, the squeeze is back on. 3. Shanghai inventories. This is ground zero for industrial demand. If stocks on the Shanghai Gold Exchange keep falling, it confirms industrial users are sucking metal out of the system. 4. ETF holdings. Are ETFs seeing massive inflows or outflows? Sustained inflows further tie up physical metal, tightening the free float. A sudden rush of outflows could release metal but also signal a loss of investor faith. 5. Federal Reserve policy. The Fed just cut rates in December 2025. Lower rates generally help precious metals. But if inflation proves sticky, and the Fed signals a pause or even a reversal, a stronger dollar could put sudden pressure on silver. Let me leave you with this final thought. The 2021 squeeze failed because it was built on narrative. The 2025 squeeze is unfolding because it's built on arithmetic. You cannot hashtag your way into creating 150 million ounces of physical silver that do not exist. The laws of physics and supply chains don't care about social media trends. This time, the smart money isn't just selling into retail hype. The smart money, the industrial users, the sovereign wealth funds, the procurement officers, has a real problem. They need the metal to build the infrastructure of the 21st century, and they're finding the vaults are running dry. The wolf, it seems, is finally here. The short squeeze is real. But that doesn't mean it won't bite you on the way up. Markets can remain irrational longer than you can stay solvent, and even correct violently within a major bull trend. Position carefully, avoid leverage, and keep your eyes on the physical indicators, not just the price ticker. The truth of this market is no longer in the charts. It's in the vaults. And right now, the vaults are telling a story of genuine scarcity.